The headlines right now are genuinely terrifying. World War III is being discussed in mainstream financial media. Trump went on CNN and said the U.S. military is currently, in his words, knocking the crap out of Iran, and then warned that a big wave of the conflict is still coming. Nearly $1.8 billion in sell volume flooded the Bitcoin market within a single hour of the attack news breaking. And yet right now, Bitcoin is sitting above $66,000 and refusing to collapse, not recovering to $66,000, holding at $66,000 through all of it. In an environment where every other risk asset is ducking for cover, that is not a small thing. And it is not the only story you need to understand right now. Because quietly in parallel, the derivatives market has set up what looks like a textbook short squeeze. And even more quietly, the US government just moved Bitcoin. Not a lot of Bitcoin, but the significance of what that small transaction signals is enormous. Let's get into all three. This is not financial advice, but these three stories together paint a specific and important picture of where this market is. Story 1. Bitcoin just passed the test nobody was expecting. In the past, geopolitical shocks followed a very predictable script. Fear spikes, investors flee to safety, gold surges, Bitcoin dumps. We saw it in 2022. We saw it in early 2024. The pattern was so consistent that it became almost reflexive. The moment a missile was fired anywhere on Earth, traders hit the sell button on crypto before they'd even finished reading the headline. That pattern appears to be breaking down. When the Iran strike news broke, yes, Bitcoin sold off. $1.8 billion in sell volume in 1 hour is not nothing. But here is what is remarkable. Bitcoin did not fall below $60,000. It held. And when the initial panic faded, it moved higher. At the time of writing, it is trading at $66,472 up on the day, with the $60,000 floor having now held twice in the past month under conditions that would have cratered it in previous cycles. John Van Eck, CEO of Van Eck, called it plainly, a very nice sign of life. And the strength was showing up not just in Bitcoin's price, but across the entire Bitcoin ecosystem. Strategy: Michael Saylor's company jumped 6.29% in a single session to $137.65 on the same day that Iran was being bombed. Mara Holdings gained 5.7%. Even Riot Platforms posted a modest gain. The market voted, and it voted for Bitcoin-adjacent assets even as the world was burning. Now, it is worth being honest about what this doesn't mean. Van Eck was also the one who pointed out that Bitcoin is still more than 50% below its October 2025 high of around $126,000. Based on the traditional 4-year halving cycle, 2026 is expected to be a correction phase, not the start of a new bull run. This recent resilience may signal early bottoming, not full recovery. And if Trump's big wave warning materializes, if the Iran conflict escalates into a full oil shock, Bitcoin could once again trade like a high-risk tech stock, and $60,000 support could be tested for a third time. None of that is off the table, but the fact that it held at all, twice, through conditions this extreme, is a data point that changes how seriously you have to take the bottoming thesis. Story 2. $70,000 keeps rejecting, but the squeeze is loading. Bitcoin has now attempted to break $70,000 twice in the space of a week. Both attempts were rejected. Both rejections were violent. Volatility is currently at its highest level since 2022, and short-term holders are continuing to realize losses at a pace that historically has marked the kind of seller exhaustion that precedes major trend reversals. The question is, how close are we to that exhaustion point? Two metrics from the on-chain data are worth watching carefully. The first is Bitcoin's supply and loss, the percentage of all Bitcoin currently held at an unrealized loss. That figure recently hit 46.3%, extending into territory that has historically marked extreme market stress. In the past 2 bear market cycles, the full bottom was not reached until supply and loss hit 60% or higher. We are not there yet. That could mean weeks or months of further consolidation before a definitive bottom is confirmed. Sustained positive ETF flows combined with a falling supply and loss reading would be the dual signal to watch for genuine market recovery. The second metric is the taker buy/sell ratio. This measures in real time whether buyers or sellers are the more aggressive force at current prices. On February 25th, the 7-day moving average of this ratio crossed above 1. Meaning buyers became the dominant force, and it has stayed above 1 for most of the week since. Glassnode noted that $70,000 has remained dominated by profit-taking, which explains the repeated rejections and signals fragility in the current demand. But the direction of that ratio is still pointing toward buyers, not sellers. And then there is the liquidation map. According to CoinGlass data, the cumulative short liquidation leverage sitting above current price levels is substantially higher than the long liquidation leverage below. There is a meaningful cluster of long liquidations between $65,200 and $67,000, which is where we currently sit and which explains some of the choppiness. But above us, the short liquidation levels are stacked. What this means mechanically is that a sustained move above current price levels would force short sellers to buy back their positions to cover losses, which in turn pushes the price higher, which forces more short sellers to cover, which pushes the price higher still. That is a short squeeze, and based on the current positioning data, the setup for one is live. It has not triggered. The $70,000 ceiling is still holding, but the fuel is there. Story 3. The U.S. government just moved Bitcoin, and it matters. On Tuesday, a crypto wallet controlled by the U.S. government moved approximately 0.04 Bitcoin. At current prices, that is about $2,500. On the surface, this sounds trivial, but the on-chain forensics firm Arkham Intelligence flagged it immediately, and the reason it matters has nothing to do with the dollar amount and everything to do with what it signals about what comes next. The U.S. government currently holds approximately 328,372 Bitcoin, accumulated through criminal and civil forfeitures, including Silk Road and dozens of other cases. That makes it the single largest sovereign holder of Bitcoin on the planet. For most of the last decade, the government's default approach was to sell that Bitcoin at prices that, in hindsight, represented catastrophic timing. Billions of dollars of potential upside were left on the table. Then, in March 2025, President Trump signed an executive order establishing the Strategic Bitcoin Reserve, formally committing the U.S. to holding rather than selling its seized Bitcoin. And this year, lawmakers are expected to vote on the Bitcoin Act, legislation that would authorize annual purchases of 200,000 Bitcoins beginning in the fourth quarter of 2026, treating Bitcoin with the same strategic importance as gold reserves. The small transfer this week is believed to be infrastructure testing, the government building and validating the wallet systems it will need to manage its Bitcoin holdings. As that reserve expands, and as the Bitcoin Act moves toward implementation. In other words, the U.S. government is not just holding Bitcoin, it is actively preparing the infrastructure to manage it, potentially acquire more, and treat it as a permanent national asset. The shift from seize and sell to seize, hold, and build infrastructure is one of the most structurally significant developments in Bitcoin's history, and it is happening right now, quietly, in the background, while everyone is watching the Iran headlines. What all three stories add up to a market that refuses to collapse under genuine geopolitical pressure, a derivative set up with a loaded short squeeze sitting above current price, and the U.S. government quietly building the infrastructure for a national Bitcoin reserve. These three stories are happening simultaneously. None of them individually guarantees a bull run. The supply and loss data says the bottom may not be fully confirmed yet. The $70,000 rejection is real, and the profit-taking pressure there is real. Trump's warning about a bigger wave of conflict is real. All of that is on the table, but the weight of the evidence, the resilience, the positioning, the government signal is pointing in a consistent direction. Bitcoin is not broken. It is building. The question is not whether you believe in the asset. The question is whether you are paying enough attention to the data to act on that belief at the right time. Drop a comment. Do you think $70,000 breaks in the next 2 weeks, or does it reject for a third time first? I want to know where this community is positioned. Subscribe if you want to keep tracking these signals as they develop. See you in the next one.